So there's two requirements for a DSCR loan. A DSCR loan is, just for like a broader context, it is a form of underwriting for a long-term lender for a project. And it's primarily based on the project first and foremost. So it has two requirements. The first of which is it has to meet a debt service coverage ratio of greater than 1. And what does that mean? That means that the gross rents for the property, whether it's a long-term rental property or a short-term vacation rental property, the gross rents on a monthly basis have to be greater than the expenses. And the expenses considered are the principal and interest on the loan and the mortgage. And so that's the ratio factor there. And then the second is clients are segmented based on their credits. And typically what I'm seeing in the market right now is there's three segments: 650 to 680, 680 to 720, and then 720 and above.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today we're fortunate to have a gentleman who's going to educate us about the intersection of hard money lending and building a vacation property portfolio. David Little is the co-founder of Crown Capital Resources, a private lending company servicing the state of Texas. He's a graduate of Texas A&M with a BS in petroleum engineering. After a long career in oil and gas, David started investing in hard money loans in 2010 and purchased his first rental property in 2013. He's now a minority stakeholder in Cribs, a vacation rental property management firm focusing on the Austin and the surrounding areas. David, welcome to the show.
Thanks for having me, Rob. I appreciate it.
Now I'm excited to have you here today because we're going to talk about things that are very, very important to vacation home investors. And the two things that I really want to get into your head on are talking about lending, especially hard money lending. And I also want to talk a little bit about management. I know you've got a lot of experience in both, but maybe you could tell people a little bit about your background first.
Sure. So my background is actually probably very different than a lot of the guests that you have on. I have an engineering background. I got an undergraduate master's from Texas A&M University. And then I've spent the last 15 years as a petroleum engineer as my standard W-2 job. I actually just resigned from that role about 6 months ago to pursue what used to be my side hustle, now is my main job, which is the hard money lending company. But throughout that entire 15-year time I was with the engineering company, I always did things in real estate. And I went down the very kind of standard path. I initially started building the rental portfolio, and then moved into some land development, then did some short-term rentals myself, owner operated, and then ultimately did my first hard money lending deal in 2017, and really just streamlined a lot of my efforts into that, which culminated in me now doing it full time.
Yeah, you talk about the side hustle, and I tell this to people all the time, especially when they're going to business. So many people just want to quit that day job, go right into that thing, and that's just a recipe for disaster if you're not set up financially to take care of it. So I always tell people, start it as that side hustle and then make the side hustle make you have to quit that job. And it sounds like that's exactly what your path was.
Yeah, that's exactly right. I tell people a slightly different thing. If somebody is single, they don't have kids, they don't have dependents, I'll usually tell them, just jump off and do it. I mean, if you're super passionate about it, just jump off and do it. You'll figure it out. However, once you have a family, once you have people depending on you, you're right. It's totally different. I mean, and to me, a lot of my friends look at me being able to quit my engineering job now and say, wow, you did it. You're so lucky. I can't believe this happened overnight. And it's like, well, it didn't. It was, 7 years we had to run this in the background, the 7 years of working on nights and weekends in order to get to the place where I was able to leave a job. And so don't expect an overnight success, but if you're passionate about it, it's not really like work anyway. It's something you enjoy doing on your downtime.
Amen to that. Amen. I want to talk a little bit about the hard money because I know a lot of investors are always looking to go, how can I get into this market? And some just don't have the resources going kind of through a traditional set of channels to get those monies. How did you start getting into that? And where did you go out and raise money and create a fund? Or how did you initially start to get the capital to start doing the hard money lending?
Yeah, great question. So when me and my business partner started in 2017, and for the first about 5 years, we were all self-funded. So we together had put together, I think, a total of around $400,000, and we were just utilizing that capital to make deals. So as you could probably imagine, that was 1 to 2 deals at a time, depending on your markets. And we really kind of maintained that for about the first 5 years, and then about approximately 2 years ago, we decided to bring on some family members because they had asked about it, and they said, "Well, how much did we earn with you guys?" And so we pay our third-party passive investors 10% on their capital. And as typically the story goes, we brought our family in, and then our friends started asking, and then friends of friends. So we ballooned up really, really quickly in the last 2 years. We went from sub $1 million in assets and in notes funded to now today over 20 million.
Wow.
Yeah. So it's kind of a really like a hockey stick. It was basically just flat for years. And then when we really started fundraising, it really took off. And to answer the second part of your question, we used to do everything on a participation model where it was kind of a deal by deal basis. But one of the first things that I really wanted to focus in on after leaving my W-2 job was actually raising a fund. So we hired a securities attorney, we raised a 506c income fund, and now we raise through that.
So the 506c, what are the parameters on that? What's the upper limit on which you can run through that?
Well, so it's an evergreen fund. So it's not a closed fund where we'd say, hey, we're looking to get to 50 million and then we close it. It's evergreen as long as we, accept new investors in. And then basically the way to think about when you make these securitized funds, essentially what you're doing for investors, besides from the financial disclosures and paperwork that you need to do, what it also provides to a third-party investor are a set of rails. And for them to know, if I'm investing within this structure, this is what you can and cannot invest in. So we had to think, very, very deeply, me and my business partner, about what does the business look like today? And then potentially what does the business look like in the next 5 to 10 years? Because what you don't want to have to do is go raise another fund or amend the fund in any way. It's a pretty ossified document once it's done.
Yeah, for sure. So it's a big process. I've got a private equity fund myself. We did a reg A+, so we did accredited, non-accredited investors for the first one. But once we hit that limit, once we got to the end of it, that's all. We were done. We had to close the fund. We can open another fund, but right now we've got what we've got, and we're investing in a lot of different markets. But for you, so when you're looking at your funds, are the majority of them going into short-term vacation rentals when people are coming to you and asking for this hard money, or do you diversify out a little bit?
So actually, what's really become our bread and butter is the real estate investors going out and doing flips. So when we take on a project and we're looking at something to fund and we're underwriting, the exit strategy is either it's a flip or it's a refinance. And when it's a refinance, it can either be a long-term refinance, I'm going to add it to my rental portfolio, or it's a long-term refinance. However, I'm going to be turning it into a short-term vacation rental. And what's really been interesting is you kind of segment out our business like that. The people who are coming in and looking at the numbers from either taking out a long-term rental or a short-term rental, the numbers over the last few years have looked better and better from a short-term rental basis. And then the second thing that we've seen, which is very helpful, is that a lot of these long-term lending companies, they are more and more accepting of short-term rental CMA than they used to be. So they'll actually utilize data like AirDNA and to help with the appraisal and with the DSCR refinance.
Yeah. So when you have people coming to you, are you acting more as a bridge until they get into the permanent financing? Yes. So what do you like to see? What kind of terms? So I'm an investor. I want to get into the short-term rental business. I'm maybe struggling a little bit with the traditional financing channels right out of the gates. I come to you, do some hard money. What does that look like for me?
Yeah, great question. And if I could, maybe the easiest illustration would be just to kind of work through a rough recent example that we funded, right?
Yeah, great.
So we had an investor come to us and find a property that needed a lot of work. He was estimating that he could take it down for $100,000. It was going to be a big rehab. This is in the Marble Falls area. And it was going to be $100,000 purchase and then $100,000 rehab. So $200,000 funds is what was needed. Now, going through the bank channels wasn't really an option for two reasons. Number one, he wanted the ability to make a cash offer and close in, a few business days. He wanted to close within the week. And then the second reason that a bank really wasn't an option is that banks don't really lend on distressed properties. And so what we underwrote it, we took a look at it and said, yeah, I think if you put the finishes in, like you're estimating, here's your rehab construction estimate, we think the actual appraised value of this after the rehab is going to be closer to $300,000. So we funded it. So again, we funded the 100% of the purchase cost, 100% of the rehab. They come out of pocket for 10% of the purchase, so their down payment was $10,000. They went through the rehab process, and then what they do at the final part of that is then they call in a long-term lender. The long-term lender comes in, has it reappraised. This particular one reappraised for, I believe, right around 300. It was a pretty close numbers. They were able to pull out 70% of that, and so I believe 75% of that. And so 75%, they were able to pull out roughly $210,000. They were able to pay us back, and the rest of the $10,000 was used for closing costs. So essentially, they now owned a property with long-term financing at lower rates that they were able to pass the appraisal. It passed the DSCR coverage ratio based on the air DNA data, and they were able to accomplish the whole project with only about $10,000 out of pocket.
Yeah, that's pretty crazy. I guess the first question people are going to have is, so you talked a little bit about the return to your investors at being 10%. So what are the costs? What kind of interest rate are you charging on the hard money?
So we do ours is 3 and 12. So it's 3 points origination and then 12% interest throughout the duration. And then we pay our investors 10%, and then, we keep that 2% arbitrage. In Texas, that's pretty standard. In nationwide, I think that's relatively pretty close, but in Texas, we keep a really close eye on our competitors, and that's about the going rate. So really, when you're doing your math on this whole project, you've got to take into account the closing costs, the down payment amount, the title fees, the property taxes, the insurance, the interest expenses to us, the origination, and you got to make sure the entire project makes sense from that standpoint. And then with those higher interest rates, that's the reason why our niche is really short-term financing. Because if you're paying 12% interest, you don't want to keep a loan open for 8, 9, 12 months. You really want to get in there, do the renovation, get that appraisal scheduled, and ideally you're in and out of our hard money loan in a 3 to 5 month period. But the nice thing about, I would say this for people who are maybe considering this, find a hard money lender in your state. We service Texas, but find one in your state and reach out to them, because when they do that initial underwriting process, they're a partner to you. So they're going to be looking at it from not just the origination, but the entire exit appraisal as well. So it's a second set of eyes for them to say, hey, I think this project is actually, the numbers are going to work out for you.
Yeah, I was going to say, most people, when they look at this type of financing, they should think of it in terms of not just a loan. They should think of it in terms of, I'm going to be a partner with this person who's going to come with the money. They're going to help me bridge this over, help me get that financing into place. And you got to kind of get your mindset out of that low interest rate type environment, because it's just a whole different thing. It's a whole different set of circumstances and scenarios where you're not probably going to get this deal. You're probably going to get a better deal, number one, because you're going to be able to buy it cash quick versus going to the bank, paying more, which will wash away some of that also. But at the end of the day, the simplicity of getting it from point A to B, getting the deal done, and then getting it turned and into permanent financing, it's worth those few extra points.
Yeah. I mean, we have one client of ours who has done this now. He's a portfolio of 24 properties. And I think the most cash out of pocket he's ever had at one given point in time is like $100,000, which is pretty wild to think about, right? Because if you're underwriting it right from the get-go, and those appraisals are coming in over either at or over what you initially anticipated, you're able to recycle a lot of your money back and immediately deploy it into another deal. So that's the beauty of this model. You look at it at face value and say, the Burr model almost shouldn't work, but it's pretty incredible what you're able to do. And yeah, you're exactly right. A hard money lender, they are just a partner in this, broader scheme of you trying to acquire and grow, a short-term rental portfolio.
I got to ask the question, has anybody gotten to that 6-month period, got to the end, got the appraisal, doesn't come in where it wants to come in at? And if so, what happens at that point?
Yeah, they have. We haven't had a catastrophic one where it was way off, but we've had one where there was slippage of, $10,000-$20,000. And in that case, the client just has to come up with the delta.
They got to figure it out.
They got to figure it out. I mean, and sometimes, don't get me wrong, actually what a lot of our clients do is they'll actually, as they're finishing renovations, they'll list the property on the MLS, and then they'll get the appraisal process started as well. Because the idea is, hey, if somebody's going to, they'll kind of list it high. The thought is, hey, if somebody's willing to pay this amount of money, I'm happy flipping it. So it actually, that way they have multiple off ramps to move out of the hard money loan as well.
Yeah, no, that makes a lot of sense. And the thing about it is so many people just don't have that cash outlay up front. And when they're looking for solutions, your traditional bank solutions are difficult, particularly when you're doing renovations and such. I mean, that's painful. It's a nightmare at times. And it holds you up. It holds up the entire process. So to have that speed, to be able to be nimble, to be able to adjust, get a deal done really quickly, but it would also be in their best interest significantly to get that deal to the finish line as quickly as possible so they could get to that final lending product too.
Yeah, absolutely. And that's what, when I tell people, we really are a kind of a niche lending product, because we are not built, and we shouldn't be built for a long-term solution. We are just gap funding. We're an opportunity for you to acquire the property with a cash offer, to get the renovations done with our funding as well, and then to move out as quickly as possible. So when, and part of the services we provide is if we have people who are having trouble getting that secondary refinancing, we've got a network of people that we can refer them to. Or, hey, I'm having trouble with my contractors. We'd say, hey, well, it turns out we know about 15 different contractor crews just in the San Antonio area. We'll make a few phone calls and get you set up.
Yeah.
So besides from the initial product that we offer, there's other benefits downstream of that as well.
How difficult is the process for these folks? They come to you. Do they go through credit checks, background checks? What do they go through to get the lending?
So the nice thing about, and any hard money loan lender will tell you this, is we lend primarily on the project. That's kind of our first lending criteria, and then secondarily on the client themselves. And that's actually countercurrent to how banks do it. And there's a reason for that. So banks lend primarily based on you as an individual, right? They're looking at your credit, they're looking at your financial background, et cetera. And the reason that is because if a bank is lending on, let's just call it, primary residence homestead, going through the foreclosure process for a bank is very difficult. Ours is different, right? So these are invested products. These are non-owner occupied properties, non-homestead properties. So if anything goes wrong, our collateral is the property. That's why they call it hard money lending, because there's a hard asset attached to the loan. So when we do a project, we're primarily considering the collateral of the property itself that we hold the first lien position on. Past that, however, what we do look at is it's a pretty standard process. We don't pull hard credit, but we do like to see what your credit score is. And I'll get to that in a second. We have a loan application. We have a general personal financial statement, just to understand it. And then we'd like to see a bank statement just to ensure that you have liquidity for the interest payments. Now, for the first component there, for the credit check, we don't go down the whole process of doing a full background check and everything like that. But we do, especially for people who want to exit with a DSCR loan, we need to be acutely aware on the front end what their credit is, because that could affect A, with their eligibility for a DSCR loan, and then B, actually their rates and their cash out percentage. So typically when somebody will approach us, we'll look at their credit and we'll actually just send over the current guidelines for DSCR lenders and say, hey, this has to pass a 1.0 DSCR coverage ratio. And then secondly, if you're in this credit range to this credit range, you're going to get 75% percent rate. If you're from, 600 to 650 this, 650 to 720 this, 720 upwards. So we let the client know this is what the current rates and market look like, and this should factor into your economic calculations.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time, and that's how do I forecast my cash flow and my profitability when investing in a vacation home. Now, if you've ever wondered that or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com. Yeah. And David, just, for those folks that are sitting out there going, what the world is a DSCR loan? We've got a lot of those new investors out there too, which I think is a great loan product. Actually, I think it's very beneficial for vacation property owners, but maybe you can tell them a little bit about what that product is once they get moved over to it.
Sure. So there are two requirements for a DSCR loan. And so a DSCR loan is, just for like a broader context, it is a form of underwriting for a long-term lender for a project. And it's primarily based on the project first and foremost. So it has two requirements. The first of which is it has to meet a debt service coverage ratio of greater than 1. And what does that mean? That means that the gross rents for the property, whether it's a long-term rental property or a short-term vacation rental property, the gross rents on a monthly basis have to be greater than the expenses. And the expenses considered are the principal and interest on the loan and the mortgage payments. So that's the ratio factor there. And then the second is clients are segmented based on their credit score. And typically what I'm seeing in the market right now is there's 3 segments. 650 to 680, 680 to 720, and then 720 and above are typically the different segments. And if you're in the highest segment, you will probably be able to pull out 75% of the appraised value and you'll get the lowest rate. So what does that mean? That means that at the very end of the renovations, the property comes in and they say, hey, the property appraised for $100,000, you'd be able to pull out 75%, $75,000 of that.
Gotcha. Thank you for that, because again, a lot of people, for you and I, we throw around a lot of these terms, and it's second nature for us. I do it all the time, and I always have to take a step back and go, oh, people are like, what the heck are you talking about, man? But it's such a great tool and such a great loan that people can get. I just want to go a little bit deeper into that. So thank you for that.
Yeah.
So what about talking about the type of person, you've got an investor, they're looking at coming in, they want to get into the business. You're saying that let's say that they have, they're kind of low on the cash flow. Maybe they've got a 10% they could put down, but they find a deal. It doesn't have to be necessarily a renovation project with you, does it? Or does it need to be?
No. The example with the renovation is kind of the easiest example I typically give, but no, absolutely not. We'll fund up to 70% of the after repair value. That's the easiest way to think about it. So if the after repair value is $100,000 in the property, we'll loan you $70,000.
Gotcha. But where people would have to be careful, I would think, I come into a property, I'm not going to do any renovations. I can get into the property, or maybe it's probably a little bit different with FF&E in there. But somebody comes in, gets into the property. With you, it's 10%. But if they're going to get into that 10%, but then they get the highest credit rating and still have to come out with, they can only pull 75% out. They do have to be cautious about that if they don't have added value after they've bought the property.
Yeah, that's why the properties that typically are the people who come to us and they don't have a renovation budget, we need to be especially careful. You need to make sure that you're buying the property at a steep discount to its current value or to median market value, I would say. That's definitely a very big consideration.
I would say the analytics too. I mean, so many people when they're buying these properties don't do the analytics on it. They buy these properties based on emotion, based on heart, but they're not really looking at what could be my income, and then what are my expenses going to be, and then what kind of repairs and maintenance could I have over the holding period. They're not taking those things into account, and if you don't understand that, when you go in and go to the bank on the other side, because on those debt service coverage ratio loans, they'll look at projected income, correct? They don't just look at the actual income or the historical. They'll look at the projected income. But it's really important to understand what your projected income is going to be when you go into it.
Yeah, that's exactly right. So typically what I've seen is they used in the most strictest sense, and some of the long-term DSCR lenders still do this. They actually require the property to be fully stabilized, which means they want a renter in the property already, or they want already operating history for short-term rental. And then you take a step back, and there are a series of lenders who will do it based on a CMA from, like I mentioned, I'm blanking on the name, AirDNA. And so typically what I've seen on that is, hey, we took a rental CMA from AirDNA. What we are historically seeing in the area is 55% occupancy, and then these sort of rates for your property, for your subject property. We will discount the occupancy 10 to 15%, and then that's going to be what the calculation we're going to use for the DSCR. So I've seen that sort of thing take place. However, what I would say is if you're new, that what you mentioned right there, Rodman, is probably one of the biggest variables that you're going to have as a new, vacation property owner. It's a really hard thing to estimate. And that's why typically with new investors, I usually don't give the recommendation, just go buy your first property and kind of see what happens. You'd probably be better off trying to just partner with somebody who's doing it. Or maybe just go work for a company for a little bit that kind of specializes in property management and things like that for Airbnbs. There's a lot of different avenues you can gain, but the way to think about it, especially if you're young, when you're young, you don't have expertise and you don't have capital, but you have a lot of time. And so don't always think to yourself, like, how can I gain the other two in the longer term perspective, right? Because that's really, where you're going to grow a lot of the business owner as an individual is once you're able to acquire experience and capital. But when you're early on, you got to realize you don't know what you don't know. And your best case scenario is to go out and get some experience. And the actionable step I would give, because I know you guys typically like to give your audience actionable information. If I'm 22 and I was looking to get into this world, what I would probably do is go to some real estate meetups or post on Facebook boards or bigger pockets. And I would say, this is the segment of the market I'm looking to get in. I live in the San Antonio, New Braunfels area. I want to own Airbnbs one day. I'm willing to work for free. And find somebody, and don't call it a mentorship program. Just say, I'm willing to work for free in whatever you want to do. And just do that, bust your ass for 3 months. And if you do really well, they're going to give you more responsibility, and they're going to give you more responsibility. And what you're doing is you're picking up real life actionable skills. You're learning about the industry, and you're either going to figure out, I guarantee by the first 4 to 5 months, you're going to either realize, I absolutely love this. It's something I want to do full time, or maybe I don't.
Yeah.
Maybe there's something else in real estate that interests me a little bit more, because ultimately where I ended up, which is the hard money lending world, there was a long road of different things I needed to try out before I fell into that. And it was like it was about 7 years in real estate before I found hard money lending. And then it was about 7 years of hard money lending before I left my W-2. So it can be a long road.
Yeah, it certainly can be. And I always tell people, get educated. And I don't care who you do it with. I don't care how you do it, but don't just jump into something. And again, I come back to the things that were happening in like COVID. So many people were making money easy because the industry was robust. I mean, it was so easy to get a short-term vacation rental. People were traveling. They were confined to their homes, so they were getting out. But now we're in this normalized market. And the problem is those wheelbarrows of money don't work anymore. You've got to be smart. You got to be educated. You got to be able to systematically work in this market. And if you don't have that knowledge and that education and the know-how to really stand out and to be exceptional, be an outlier in the space, you suffer. And it doesn't matter where you're at in your career. Even the people that are not new, maybe those people that are kind of in the middle, that are intermediate, you still need to be exceptional at what you're doing right now to really stand out in the market and to be really good at and make that money that you want to make. So get that education, whether it's I know you didn't want to use the word internship or mentorship or whatever it might be, but at the same time, whatever it is, go get educated and advance yourself professionally in this business. Otherwise, you're just going to fall behind and you're going to wonder why you're not making any money.
Yeah. Well, and don't get me wrong. It'd be amazing if you could find an internship, but I guess my for clarity on that point, if somebody called you, Robin, and said, "Hey, I want you to mentor me,"
Don't have
your
time.
response would be like, "Oh, well, I'm really busy," as it turns out, right?
Yeah.
But if somebody called you and legitimately said, "Hey, I'm 22, I love this industry, I'm willing to work for free, just give me the stuff that you don't want to do and let me like knock it out of the park." If any business owner gets that call, you're going to go, "Okay, I'll throw some stuff your way. Let's see what happens here."
Exactly. Hey, David, you got a little bit of management experience too. You've got a management company. You manage short-term vacation rentals. I want to talk a little bit about that while I've got you on the line here. But talk a little bit about so many people come into the industry, and number one, they think management is going to be easy. They think it's kind of like, you've got that office building where you've got a long-term tenant, or you got a 12-month lease on a house, and maybe you pop in a couple of times. But short-term vacation rentals are very, very different. They're management intensive. They take a lot of work. They take a lot of energy. What are the pros and cons between self-managing and then hiring another company just to handle the management for you?
I think I would highly advise somebody who's getting into this space to consider having a third-party management company, and for several reasons. Number one, it's a lot to take on for an individual owner-operator to just jump into something and not know a lot of things. Second added piece, there's two other added pieces. That the second piece is if you come on with a good property management company, they have a ton of experience in the market that you're in, and they're going to be able to tell you, where to put the money, where not to put the money, what things that they're seeing. A lot of these groups even have a suggested product list on Amazon. It's pretty amazing. I know we do. So if somebody were to come in and say, "I've got a 3-bedroom, 2-bath, 2,000 square foot place, and here's kind of the market, here's kind of the look," the property management company that I own a stake in, they will essentially send an entire Amazon order over to you, and it's just a one-click buy. Hey, we've bought all the different bedding and sheet materials. This is the one to go with, right?
Yeah.
This is the paper towel, and it's things you don't even think about. Here's the plates we recommend. Here's the silverware we recommend. Here's that. That's kind of another huge addition. And then the third thing about having a property manager is it overcomes the initial challenge of getting a new account on Airbnb, which is you don't have any rental history. And when you go read books on Airbnbs, the search results are queried based on heads and beds. I'm sure you've heard the term, right?
Yeah, we use it all the time. Heads and beds.
Yeah, heads and beds. And so it's like initially, it's like you got to get bookings. But the nice thing about being under the umbrella of a property management company is you're already in the superhost status, so you can get kind of grandfathered in, if you will. It's also another thing is it just clears your headspace as well to potentially go out and look for the next Airbnb company. I'm sorry, Airbnb property that you're wanting to acquire. So those are the huge pros. The cons are what they are. I mean, it's expensive, right? You're looking at, depending on the group, 15, I've even heard up to 22, 23%. Yeah. So it's expensive to go in. But it all depends on how active you want to be versus how passive you want it to be. I mean, if you have a W-2 and this is just something you have on the side, like definitely look getting a property manager. But the best actionable advice I could give somebody who's getting out into this game, let's say you've acquired a property, you kind of know what you want to get into, where you want to get in, what price point, is go get on Airbnb and find a comparable property and go stay there. And pay close attention to what are the amenities offered, how clean is this place, what are some details in there that I really like, what are some things that I didn't like, how is their owners book when you walk in, did you love it? Well, take pictures of it. Did they put out a nice bottle of wine? That was one of the things my wife and I did. We went and stayed at one, and the owner set out a $20 bottle of wine with a handwritten note. And we just thought it was such a nice touch. And so that's something we started doing. And if you think about it, somebody's out booking they're paying $2,000 to book the place, and you're buying a $20 bottle of wine. It's like a 1% cost there. It's nothing, right?
Yeah.
But it's super meaningful. People come in, they sit on the table, 2 glasses of wine. Hope you enjoy your weekend. Thanks for sharing the space. It's awesome, right? So it's small touches like that. So if you're really serious about getting into this game, like go have that experience. Go tour some local places and figure out, who are my competitors and what do I have to do to beat them out? because like
Now,
you said, Robin, it's hyper competitive these days.
hyper competitive, and you can stand out, right? Like you said, doing some very small, significant things.
Yeah.
So they feel very small, but when the tenant comes in, it's so significant to them. And down in Costa Rica, we literally have, when guests come to our properties in Costa Rica, we've got a big plate of fresh fruit. We've got the pineapples and the bananas and people love it. I mean, it's fresh fruit. It costs us maybe less than, maybe $10 in total. But to come into your property, you've had a long day of travel, and there you've got this huge plate of fruit, sitting there. And we've got a take a beer if you want one and leave a beer if you got one kind of program going on. And it's nice. It's this very, very small, inexpensive way to stand out in the market.
Yes. Yeah. That's huge.
So David, I think, I would like, number one, I want people to figure out where they can go to find you. Where's the best place to reach out to you?
So I'll just provide my email address. It's david@crowncapitalresources.com.
Great. And you kind of went over it. You kind of answered a question that I usually ask at the end of every podcast already. But one piece of advice that you would give to that new person coming in, maybe their eyes are wide open, they're trying to figure it out, but they're not quite sure. What's that first piece of great advice that they should get when they're making their first steps in?
I would find a partner as somebody who you could work with or provide some value to. You as a young entrepreneur, you're need to completely focus on providing value to other individuals. That's kind of one of my general rules in life. But, coming out of the game, just figure out how you can provide value to individuals. Your goal is to use what you have in abundance, which is time, create value for other people and gain that experience and figure out, is this something I really want to do? Is there something else in real estate? You might even, even within short-term rentals, there's a massive amount of things that you could do. I mean, you could be the guy who just procures materials for the Airbnbs. You could be the guy who just owns a, property service company. You could be the guy who owns a cleaning company for Airbnb. I mean, there's so many things that you could do. So don't be in a rush to, so don't be so dogmatic and concrete on this is what I want to do. Just go in with wide-eyed saying, I want to gain some experience. I want to provide value to other people and see where your interest and expertise really lie.
Yeah, that's great advice. David, thank you so much for coming on the show today.
Thank you, Robin. Thanks for the opportunity to be here.
Thank you for tuning in to this episode of the Vacation Property Secrets podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets podcast.